Let's jump right in. Today, we're putting on our expert analyst hats for a complete teardown of the massive fiscal half-year results from BHP Group. If you follow global resources at all, you already know BHP is the ultimate bellwether. So let's unpack these numbers ending December 2025 and see what's really under the hood. And we're going to start right at the climax here, a staggering 28% jump in half-year profit attributable to shareholders. That nets out at a cool $5.64 billion US. In a macro environment that's actively squeezing industrial margins, this kind of cyclical outperformance is huge. It really proves BHP is just firing on all cylinders right now. To see how they pulled this off, here's our roadmap for the explainer today. We'll quickly cover their mining footprint, then break down the earnings, look at their record production, shareholder rewards, the balance sheet, and finally, their future strategy. Okay, Section 1, the mining giant's footprint. To truly appreciate these financials, we've got to grasp the sheer size of the machine we're looking at. Founded way back in 1885, BHP has grown into the undisputed apex predator of global mining. We're talking about a sprawling operation with over 91,000 employees. That is literally the population of a small city, all working to pull critical resources out of the ground, from Western Australia all the way to Chile. Moving on to Section 2, breaking down the earnings. So, how exactly did they get to that $5.64 billion profit? Just look at the flow of these numbers. Revenue grew by 11% to $27.9 billion. But here's where the massive operational leverage kicks in. That 11% top-line bump cascaded straight down to create a 25% jump in underlying EBITDA, and ultimately that 28% explosion in net income. It's beautiful to see. Look really closely at the margin here. BHP's underlying EBITDA margin improved to a phenomenal 58%. Now, if we apply Warren Buffett's investment lens for a second, a margin this thick is a classic indicator of a wide economic moat. Literally, for every dollar of revenue they bring in, they're keeping 58 cents as poor operational profit. Getting to that level requires incredibly strict cost discipline and, of course, world-class Tier 1 assets. Which brings us to Section 3, record production driving growth. What's actually driving these margins up on the ground? Well, it's essentially a perfect storm of flawless operational execution and some really favorable pricing. BHP achieved record production volumes at the exact moment the market demanded them. Copper prices surged by 32% year over year, mostly driven by the global push for electrification and EVs, and iron ore ticked up 4%. Max volume meeting max pricing equals some serious margin expansion. And CEO Mike Henry makes it crystal clear this wasn't just luck. Just look at his words here. By leaning heavily into future-facing commodities like copper and potash, BHP is intentionally aligning its entire portfolio with massive, multi-decade macro trends. It's totally strategic. All right, Section 4, rewarding the shareholders. So, what does all this staggering profitability actually buy you as an investor? Well, Benjamin Graham's defensive investor checklist always looks for a strong, stable dividend record, and BHP absolutely delivers on that front. They announced a massive 46% hike in their interim dividend, up to 73 US cents per share, which pushes the yield to a very attractive 3.19%. Management is clearly confident enough in their cash flow to pass these wins directly back to the owners. On to Section 5, the balance sheet health. Now, as any analyst will tell you, a high dividend is only safe if the balance sheet can actually support it. They generated an incredible $9.37 billion in operating cash flow in just 6 months. Compare that to their net debt of $14.7 billion. Any value investor is going to love a manageable debt load, and BHP specifically targets a range between $10 and $20 billion. By sitting right in the middle, they're perfectly balancing those shareholder payouts with rock-solid financial stability. Finally, Section 6, future outlook and strategy. So how does the world's largest miner sustain this kind of momentum? By spending heavy capital. BHP is committing a massive $11 billion annually in capital expenditure for 2026 and 2027. This money is flowing straight into expanding their Tier 1 assets and pushing greenfield projects, like the Jansen potash site in Canada, basically ensuring they control the supply of commodities the world is desperately going to need next decade. Looking at the broader market, we know inflation is a persistent threat to those incredible 58% margins we talked about. To combat this, BHP is banking on global economic growth holding steady at around 3% to support core commodity demand, all while enforcing some ruthless cost discipline internally. That 3% growth rate is really the crucial variable for their future valuation. Which leaves us with one final thought. As the world rapidly electrifies, builds out these massive green energy grids, and demands more efficient agriculture, is BHP building the ultimate foundation to be the undisputed engine of our future economy? Based on the numbers we just ran through, they're already laying the groundwork. Thanks for joining this explainer, and definitely keep your eyes on the commodities market. It is moving fast.